If you're hiring your first head of sales, head of customer success, head of anything where you haven't done that thing before, or like don't have a lot of experience with it, ask people you know that and respect, like who's the best customer success person you know, and then talk to 2 or 3 of those and try to understand like what do they do day to day, what makes them special, and then maybe that gives you a little bit of a sense of like, okay, here's what like the top 5% or 1% looks like. I guess there's wrong track and right track. Trying to like outsource sales from day one, I think that's usually the wrong track. I think you do want to have founder-led sales, be in front of customers as much time as possible early on. One of the wrong track things I see most often probably is starting with like a manager, but not a doer. On the right track side, just prioritizing go-to-market is really important. If it's not something you're thinking about, usually that's the bad sign.
Hi, this is Alex Shartsis, and I'm excited to talk to Leo Polovets from SUSA Ventures today. As you know, this podcast is about go-to-market, and we talk to people in the startup ecosystem that are focused on making startups successful. And so Leo and I go way back, over 10 years now, and I'm super excited to talk to him about this. Leo, do you want to introduce yourself for a minute?
Yeah, absolutely. I'm excited to be on the podcast, Alex. So my background is I used to be a software engineer for about 10 years. So I was pretty fortunate. I was one of the first hires at LinkedIn in the early 2000s. Then worked at Google and then in another startup called Factual for about 4 years. And then started SUSA Ventures about 11 years ago now with a couple other partners. So we have a $125 million seed stage fund that mostly invests in traditional tech. So kind of, $1.5 to $2 million checks in B2B SaaS, healthcare, fintech, things like that. And then a couple of years ago, I also spearheaded a deep tech fund for us called Sequoia Ventures. And that fund does 250 to 500K checks and areas like robotics, climate and energy, defense, kind of some of the more fun off the beaten path sectors that have really emerged in the last couple of years. So I would say come from engineering, so I'm not a go-to-market expert, but I do feel like I've gleaned a little bit here and there over the last decade. And so it's been a good learning experience. And I think now there's, kind of some lessons I've seen across a lot of companies that maybe, new companies I work with can benefit from, hopefully.
Awesome. Well, congrats on the new fund. I can't wait to talk about that because I think go-to-market for deep tech is always super interesting and a little bit scary. Why don't we start just at a high level? What do you look for from a GTM perspective? And maybe go stage by stage. So seed stage, that deep tech fund, all the way through to by the way, what's the latest stage you guys invest at that you would start, or is it all seed?
Yeah, so SUSA and Humba are both pre-seed and seed. And then we have an opportunity fund called B2B Ventures that's more Series A and B, and that one it's more sector agnostic and it basically invests like post-product market fit and, once there's like some decent traction.
Cool. Well, yeah, I mean, product market fit sounds like a good place to start. Like, what do you look for in the seed stage or pre-seed, and then what changes Series A, Series B?
Yeah, maybe with the caveat that I spend most of my time on the early stages and not the Series A and B side. I would say for pre-seed, most of what we're looking for is like just some interesting hypotheses and like what go-to-market channels might work, maybe like what the go-to-market team might look like over the next couple of years. But, it's pre-seed for a reason, right? It's often like super early. It's maybe like a month in or a couple months in. So there's usually no data at that point. It's just more like you're looking for the founder to have, like an interesting point of view and like, here's a strategy we think that would work. Maybe like, here's why we think it would work. So that's pre-seed. At seed stage, usually the founders have tested 1 or 2 of those things, or maybe like 5 or 10 of those things, and they have a better sense of, like what a good go-to-market direction would be. Maybe they're starting to like narrow in on their ideal customer profile a little bit. And so the seed stage is sort of like you have these things that seem like they're starting to work, and you want some capital to continue to build the product and also double down a bit on the go-to-market channels that seem like the most promising. And then I think Series A is like you have it working, for the most part. And now you're ready for like, significant capital to like really start scaling the sales and go to market more. So I think stage wise, that's sort of what I'm looking for. Then at the early stages, the other thing I want to see is like, at least one of the founders is either a business founder, or sometimes the founders are all technical, and that's great too. But at least like one of them is like, business minded, right? Where they're not just thinking about, we want to build this product. If we build it, we'll figure out go to market. Like somebody on the team should be thinking about that from day one and thinking about like, who is the customer? Like what's their pain point? How do we solve it the best way? Because if you're just focused on the tech and the product, it's very easy to kind of, end up building the wrong thing or building the right thing, but like not having enough time to figure out go to market.
So true. That happened to me once, and hopefully never again. I think that you hit on something really interesting, which was like having a founder that knows business or is business minded. How much of that is like knows how to run a P&L? How much of that is actually knows how to sell or knows what marketing is? Or does it not matter as long as they have some flavor of what business looks like?
It's a good question. I would say like the best way I can answer it is like you don't have to be amazing at it, but you can't be awful. And so in the early days, like most companies do like founder-led sales, founder-led like lead generation. I think if you're like a B- or C+ or better, it's fine because you're not trying to build the most efficient sales org. You're mostly just trying to get in front of customers, like learn what they want, hopefully close your first couple of deals. And you can be like decent for that. You don't have to be amazing. And then, if you're decent enough to close the first few, that's when you start hiring people that are, focused on sales. It's their career. They're much better at it. I think maybe where you get into trouble is like if the founder is like an F at sales, it's really hard to, like if all the founders are Fs at sales, it's very hard to like, get far off the ground.
Yeah. So talk about that, because there are a couple of things in there that were super interesting. First, that like, you can be a B or a C, B- or a C+ and still like be good enough to get to the next stage. I mean, one of my big things is founders don't have to do everything, because when I was a founder, everybody told me how to do everything. And I'm just frankly not good at things that aren't partnership sales and corporate stuff. Like, for example, immigration, I'm not very good at it. But I think that, so part of me is like, well, how early can you go, and how early is too early to bring on that salesperson? If you're a C or maybe a D, so you're not quite an F, but you're not good at it. And then, what does that look like? Can you tell that somebody's like passable at sales? If I'm a technical founder, how do I kind of self-assess to think like, oh, I'm good enough to do this for a little while, or I really need help?
Yeah, I would say it's a great question. I think a few things that come to mind is one, there's other avenues for sales, right? So there's selling to customers, but there's fundraising, there's recruiting.
Right.
I think in a way, those are good like self-assessments of like, are you good at sales? Because like, for example, if if a bunch of people pass your technical interview, but either, you give them an offer and they don't join, or maybe, you start interviewing them and they bow out because they're not excited about your company or what you're building. Maybe that's a sign that like you're not very good at the sales process. Because I think almost any company, you can make it sound pretty interesting, especially if you understand like what the person on the other side is looking for. So I think like there are multiple ways to self-assess. I think probably trying to sell is the best one, right? Which is, if you pitch, 10 prospects or 50 prospects, like if none of them get anywhere past the first meeting, like that's probably a sign that you're not doing a good job, or that, you don't have that skill innately. On the other hand, if like 3 of the first 10 are like, oh, can I do a pilot with you? Or like, let's do a second meeting or a third meeting. Like maybe that's a sign that like you're decent enough at it. I'd say like if you really think you're an F, and sometimes like, the investor will give you that feedback, hopefully nicely, right? Which is like, hey, the tech's really awesome, the market's cool. Like, I think you should find like a business co-founder, or like, hire a salesperson or something. But I think if you're really an F, like you should probably find either a co-founder that, is complementary there, or, maybe you do want to like have an early founding team member that can help with that.
So how appropriate is it to take a seed round and spend that hiring somebody to do sales? Like, do you suggest that? Would you be concerned? Would you rather them get somebody part-time? Like, how do you balance that?
I would say like, in my mind, it's definitely doable, but it's sort of less ideal. I think as you scale up, like the goal of sales is sales and like revenue, right?
Right. Yeah.
I think in the early days,
coffee is for closers.
Sorry, can you say that again?
Coffee is for closers, right? I mean, third prize is you're fired.
Yeah, exactly. So like, as you scale up, like you want someone that can close sales. In the early days, I think closing sales is like some fraction of what you want. Maybe it's 25%, maybe it's 70%. But a lot of it's like understanding customers and customer development. And so I think one of the big goals of like founder-led sales is not, hey, can you close whatever $1 million in revenue in the next 2 years? It's, can you talk to enough customers that you better understand their pain points? Like, what are the messages that resonate? Maybe like, where do they hang out? What are some strategies that could work? And then as you learn those things, you can hire appropriately to like, to get kind of people that are more experts in those areas to help you level up on the go-to-market side. But I think a lot of the early sales motion is basically like for like understanding customers better. And so you can outsource that to like an employee. And I think that's okay. And it can work, but it's just, I think it's sort of riskier, right? Because, what if they're just focused on sales and like maybe they don't pass on the lessons that they get from customers well to you, or they don't pass them on at all, or they learn something different than what you would have learned if you had done it. Right. So I think that's the main downside. I think it's not like you're going to fail. I think it's more like, hey, maybe a chance of anyone figuring out how to sell your product is like 50%. And then if you hire someone to do it, it's like, well, it's 50% times what's the chance you hired the right person. And so like it just kind of knocks the odds down a little bit.
So you're basically almost worse off if you hire somebody and outsource it to them, because there's a risk that you just didn't hire the right person.
Yeah, right. Because I think that's the risk, right? You hire someone that's okay, they're not that great at themselves, or maybe they're a great salesperson, but like they don't really understand your industry or your product the same way that you do. But then if they don't do a good job, it's like, well, you wasted a lot of time for the company, which has limited runway. But you also didn't make progress, and now like you still don't have a good go-to-market.
You still have to hire somebody. Well, and that kind of leads into another question, which is what it shows that somebody's on the right track at sort of these different stages. So early on, you said a couple founders, good idea, right? Maybe they've proven they can execute somewhere else. Maybe not, but you don't expect sales, right? But you said later on, there's more indicators, right? You've tried things. Like, can you talk about what that looks like what the indicators are that they're maybe haven't figured out product market fit, but they're on track to get it?
Yeah, I'd say I guess there's wrong track and right track. I think on the wrong track, I do think for the most part, usually if you're outsourcing it, unless it's sort of by necessity where you're terrible at sales, but you're self-aware, you're like, the best thing I can do is just hire someone to do it. Usually if that's not the case and you're still trying to like outsource sales from day one, I think that's usually the wrong track. I think you do want to have founder-led sales and like, again, just be in front of customers as much time as possible early on. I think not being deliberate is another like wrong track thing, right? Which is you have some go-to-market decisions, but when someone asks you like, well, why did you like target this kind of customer instead of some other one? Or why did you do like AdWords instead of, billboards or conferences or whatever? And your answer is not like, well, I analyzed the 10 possibilities and picked this one. And it's just like, well, I just tried it because it was easy. So I'd say like, I think being deliberate about it, like about go-to-market is important. And then if you do hire, I think one of the wrong track things I see most often probably is starting with like a manager, but not a doer, right? Because people are like, oh, I did some founder-led sales. It's kind of working well. Let me go hire like a VP of sales. But it's like, well, the VP of sales has no one to manage. And maybe if they've been a VP for a while, they're like, they're not, they're kind of rusty at like doing sales themselves, or they don't want to do it. So I think in the first couple of hires, my sense is you want doers more than managers. And then once that's working, you want to hire a manager to like manage them and then scale the team up. On the right track side, I do think like just prioritizing go-to-market is really important, right? So like I said, if it's not something you're thinking about, usually that's like a bad sign. I think in general, a lot of times what I see people do is the founder does founder-led sales for a while. And then as things start working, they basically start hiring to like fill the gaps, right? So they're like, oh, I'm really good at closing sales, but I just don't have enough leads. Like, let me get an SDR. They'll get me more leads and I'll close more sales. And at some point you're like, okay, now I have too many leads. Like I can close some of these. I need help. So like, let me hire an AE or two. And then as you scale that up and it starts working, I think that's when you hire a manager. But I think that sort of like need-based go-to-market hiring works pretty well in my experience. I think that's a sign you're on the right track.
Yeah, I couldn't agree more. I think one of the big mistakes I've seen is hiring somebody senior, especially at like a Series A company, where they bring all these skills you don't need, like forecasting and actual management and career management, all this stuff that like really doesn't matter at that stage. In my opinion, at that stage, it's more about like, let's just sell some stuff, and hopefully do it on good terms. And yeah, there is a profile of that sort of hungry mid-career person who isn't managing people, but like wants to build the sales deck, right? And is actually capable of building a sales deck. Yeah. Versus that like VP of sales that wants the designer to build the sales deck.
Yeah. And I've seen that a lot. Like I even see it at like seed stage and not Series A, right? Which is someone gets like a CRO or like a VP of sales or something. Right. And it's like, they spend 6 months or 12 months setting up like Salesforce in just the right way. And like they do all this stuff that like it sets up good processes, but you haven't sold anything and you have like very few customers. And so it's sort of, it's like trying to like build a social network where you're like, I'm going to optimize for 1 billion users from day one. And it's like, maybe better to just like focus on getting the first couple thousand users.
So I think that's so, I see that so much because you end up, I see both sides of it, right? One side is like you're trying to fix the plane in flight because you're now at a couple million in ARR and your CRM is crap and you have no idea where the leads came from or what was working and what wasn't working. So, that's fixable though, because you have a couple million in ARR. And the other thing you see is like you have this super built out CRM, no customers, right? And like to go after a new market now, everybody has a sunk cost. Like, oh, but we did this, or the landing pages do that, or the website says this on it, and it's like, yeah, but it didn't work. Like, let it. What are you trying to solve for here? Like a perfect go to market motion with no customers, or maybe some revenue. I think both things happen. Well, in terms of like the go-to-market, like the actual infrastructure for it, how important is that? Like you mentioned sort of your Salesforce is set up. Like at what stage do you as an investor ever care? Or is that something that, just like, oh, by the time they get to Series B, they've set up the infrastructure right?
Yeah, I think it's more of that, right? Which is like, I think at some point, if you want to be a great company, you can't do it all in like, pen and paper or like, right. Lots of like, Google spreadsheets all over the company. But I think that the time for that stuff's probably like Series A or Series B and not pre-seed or seed. I think it's just sort of like premature optimization, right? Like to your point, right? Like you're like, well, you're trying to land the plane and like, okay, you're building an airport for like the planes and you have like a little Cessna. You don't want to be like, let me build an international airport. You're like, no, like, let me just build something that like the plane can land on. And then as maybe I get more planes, I could build something bigger and bigger. But like the infrastructure should evolve with like the go-to-market progress. And you shouldn't build all of it from day one because you should be focused on the actual like targeting customers and revenue from in the early days and stuff.
Yeah, I'm curious if you have examples. I know one of the companies I worked with, they had 2 salespeople. They had 4 and let 2 go. They had 2 salespeople and they were obsessed with balancing the lead routing fairly. And from my point of view, I was like, you have 2 salespeople. Like Joe gets that one, Mary gets that one. Like we're done here. Why would we spend time and money on setting up our CRM to be able to lead route with 2 people? I'm curious, like, are there examples where you've seen, in different industries where things have been either overbuilt or underbuilt?
Well, I'd say underbuilt. Like I've seen companies, at Series A, like running off of like an Excel spreadsheet and not even like, a basic CRM or something. So I think those things get pretty complicated when everyone's sharing the same spreadsheet and it's pretty hard to edit it all at once and like things break. So I think you want some minimal infrastructure and there's a lot of like nice kind of simpler tools like Pipedrive and Streak and maybe like HubSpot, stuff like that. So I think underbuilt, honestly, like it's less of an issue usually because even if you have, tens of leads per month for your B2B company, or maybe it's even like 30 or something, like you can do a lot with pretty minimal software. I think it's like when the pain point gets great, that's when you want to make sure you transition to something better. Either when that happens or maybe like a few months in advance of that, but you don't need to do it a few years in advance of that. Because I think the biggest thing is like companies have very limited runway, right? Like, so you raise around, maybe you have 15, 18 months, maybe on the high side, it's like 24 or 30, but there's only so many resources you have. And so you're kind of looking at like, what's the ROI of, I have this like 150K, I can spend it on like a Salesforce consultant or, like a manager, or I can spend it on a salesperson. And you want to think about like, well, what's the ROI of that relative to other things you can do? And frankly, at a seed round, I think that ROI is much better on a salesperson because you're like, hey, they'll help me go from, 300K ARR to $1 million ARR in a year versus like sales tooling will help me go from like 300K ARR to 400K ARR, but I'll have really good tools. Right. And like that just like the former is way more valuable. But as you get to later stages, that equation flips, right? Because maybe you're like, hey, I have like 5 salespeople and getting a 6th one gets me like an extra little bit of ARR. But instead of getting like a really good Salesforce install going or whatever CRM you're using, maybe it makes like my 5 salespeople 30% more productive, right? And now you're like, again, like a salesperson and a half for the cost of like, like better software. instead of just, hiring one salesperson. So like that, you kind of have to think about like the ROI and the leverage of your decisions, like given you have limited runway.
How much on this note, right? You've got you've got your one salesperson. You can have your one-on-one with them every week to find out how he's doing, right? When you've got 5, maybe they're traveling, they're on planes or conferences, right? You're a little bit further along. How much does reporting and dashboarding and things like that matter? And does any of that trickle up to you as an investor where you can tell like, oh, this person's just trying to like, I don't like, they have no idea what's really going on with their business. They're kind of making stuff up versus like, oh, this person's really in the driver's seat, and knows all the levers.
Yeah. To be honest, I have like less experience here because I'm not always like, privy to what companies do internally. I do think like some dashboarding or metrics are good to track. It can be really basic, right? It could literally be like an email once a week of just like, hey, somebody spends 20 minutes, Monday morning to summarize like the leads and sales and progress last week, and then sends an email. So it can be pretty basic. I think, a lot of times like a couple of those key high level metrics get funneled up to investors, right? Like what's our revenue, what's our ACV, what's our like, CAC, for example. So I often see the higher level numbers. I think like, I think some metrics tracking is good because like basically like whatever you measure, you optimize. And so, and I think you want to make sure you measure the right thing, right? So a lot of times, for example, like companies will, they'll try to optimize for like number of pilots. You're like, that's great. But at some point, like they got to convert to contracts. And, if you have like 20 pilots going to 25, doesn't move the needle as much as like trying to convert, a couple of those 20 into something that's long-term. But so just like whatever your high level, like North Star metric is, just make sure it's something that you want the team to optimize because that's what they'll aim for.
That's a great point. My next question is going to be about mistakes that you see founders make that really make an impact to their outcome. But I have to like throw pilots into there because pilots are kind of they to a certain extent killed the company I started because we had all these really big enterprise pilots that, it turned out we didn't quite have product market fit. And you spend 3 months working with enterprise or with Circle K or with some really big global company, mostly cleaning up their crappy data. And then they wouldn't convert, right? And you're out, data scientist, maybe a data engineer, 3 months, you didn't build your product, but, and then, I had a PhD, machine learning PhD quit because we didn't close the pilot he worked on. And he was so disappointed. He put so much effort into it. He was like, I'm going to go back to academia. This startup thing sucks. So what are the mistakes that matter? And particularly because I'm sure there's one in pilots, like are pilots one of those mistakes?
I would say like maybe generalizing that. I think vanity metrics is one, right? Which is like, oh, we have a bunch of users, like we have a bunch of customers, but they're not using the software or something, right? So like the vanity metric is like, look how many accounts we closed. But then the reality is like when you fast forward 6 or 12 months, like that's not going to end well. I think pilots is another one, right? Which is like, look how many pilots we have. But if that number, like the goal of pilots is not to have pilots, it's to get customers. And so if you fast forward like, a little bit and none of them become customers, like that's not saying you need more pilots. It's saying you have to figure out how to actually like convert people because maybe the product's not working well enough. But I think in general, like there's sometimes a focus on vanity metrics. And so I think you do, or like, users are super engaged, but like only on the free tier, and on the paid tier, like nobody signs up or nobody uses it or whatever. So like there's lots of ways to slice it, but you just want to make sure that, again, like you're kind of focusing on what matters and not just like maybe like the metric that makes you look the best. Because like it'll make you look the best for a while, but then at some point you're out of money.
Well, this goes back to what you said about being intentional too, right? If you're kind of diluting yourself by saying, oh, hey, we have a lot of free users and they're logging in once a day, isn't that great? But nobody's ever bought it, right? Like, are you keeping your eyes on the things that are important? Are you being intentional about how you manage your product? Well, like, on pilots, because this seems like for deep tech, stop me if I'm wrong, but for deep tech, like pilots must be pretty common because people don't know that the technology is going to work. They have, also maybe even the people building the technology aren't totally sure that it's going to work. And so, pilots are a thing. Are there do's and don'ts? Like, are there things that you could say like, oh, the companies that set up their pilots in this way tend to be more successful, or is it pretty random?
Well, I would say, I'm definitely earlier in the deep tech side. I'm a couple of years into investing here, but I actually think a lot of the same lessons apply. in the way that, even on software, right? Like sometimes you see a piece of software and right away you're like, oh, this would have a huge ROI for me. Like, how do I buy it? Or like, how do I show it to the rest of my team? And other times you're like, well, like if it works, I think it would be valuable. I'm not sure how valuable. Maybe you need like a trial or a small pilot or something like that. I think the hardware side is pretty similar. There's more technical risks, right? So like if somebody's developing it, kind of while they're trying to sell it to you, maybe you want to try like a little pilot, just to be like, well, how would this work? So that like when this is ready in a year, I can decide if I want to buy it or not. But a lot of times I see the same approach on the deep tech side, which is, maybe you're selling some like warehouse automation solution or some agriculture robotics solution. And you often start with a small pilot and it's like a proof of concept, right? Which is, hey, you have this like 10,000 acre orchard, like let's try this on like 5 acres and just, I'll show you the value. And if it works well, like let's do it on 500 acres. And if that works well, let's do it on the whole 10,000. But I see that mechanism pretty frequently.
So, one of the companies I publicly advise, Vanity Agriculture, has that where they have micro robot things for irrigation on vineyards and other industries. And the thing that shocked me was like, they need a year. You need a year to do the pilot because you need to install it, see how before planting, and then go through a whole growth cycle, which it turns out is a year. And then they'll decide whether or not they expand. So it made their metrics look pretty bad for the first couple of years because they had all these huge pilots with like thousands of vineyards, thousands of acres under management, and they were on like half an acre. So it's like how, so, I guess that gets to like, you really as an investor need to know the business or understand like, oh, they've got the big pilots. They'll do well. How much of that is on the investor though? And how much of it is on the founder to be able to explain that? Because they struggled from a fundraising standpoint for a couple of years. I think they're doing really well now, but it was tough because it's like, why don't you have more?
Yeah, honestly, like, I think this is probably the place where like deep tech and traditional tech investing diverges a bit, where like the pre-seed rounds are kind of all the same. It's like almost everything, you're kind of buying into like the team and the vision. And then like maybe like the series C or something is scaling, but the transition point for like traditional versus, deep tech is pretty different in that a lot of like let's say SaaS companies have meaningful revenue by the series A, especially by the series B. On the deep tech side, it's like maybe you have some revenue for the series A, but a lot of times like it's still mostly product work and then you have some LOIs or something. And then for the series A, it's like, hey, it's your first deployment and you kind of validate that this thing works and then somebody will pay you for it, but maybe you still don't have a lot of traction. And then maybe at like the series B and later, that's when once the thing is working, everybody wants to buy it. But it takes a lot longer to get to that like kind of rapid growth and revenue scaling standpoint. At least that's been my experience so far. And sometimes there's hacks you can do, right? So I would say like, for agriculture specifically, one I've seen is like there's two, there's northern and southern hemisphere. So like a lot of times you're tied to a growing season, but if you go like, like south of the equator, there's like a second growing season that's 6 months offset. So like at least you can kind of cut your iteration speed a little bit or iteration frequency. Actually, no, you can grow your iteration frequency. You could double your iteration frequency. So that's like one idea for agriculture specifically. The other part, and I think this applies to both hard tech and like traditional software, is you really want to like narrow in on an ICP because like the more desperate the customer is for your solution, like the faster they'll expand, right? So like, for example, for irrigation, maybe if you go to like Oregon where it rains a lot, like those pilots and rollouts are going to be really slow. And if somebody's trying to like grow something in like, I don't know, Arizona, like I bet their rollout was much faster and they're like much easier to talk to because it's like irrigation is probably a big problem there. And I think that's true for anything you're selling. It's like, you don't want to just target, like every customer, like no matter what. You want to try to figure out like who has this need the most, who would be an early adopter, who has a budget. And then the more thoughtful you are about that, and like the faster you test it out, the faster you can grow.
Yeah, I think that, one of the interesting things about probably deep tech, but even other startups is that you end up with this sort of gap between like the original pitch, like, oh, we're doing this because of global warming, right? And there's, water is more valuable and harder to get. And so people need to be more efficient with it or whatever that macro trend is. In industry, it's, people are the boomers are retiring. There are less people that want to go be an operator at a factory. So we need to, we have all these needs, which are great for a pitch deck when you don't have any metrics. But when you get into like actually selling to customers, those are usually not the reasons why they buy. right? Like they're usually reacting to something specific. And I'm curious if you see like some founders, I've seen founders really cling to like, no, the website still says we're solving global warming, right? Even though they found more specific, needs amongst their ideal customers. Is that something that you've seen or helped people through?
Yeah, I would say like, I think that to me would sort of be like a sign that maybe you're on the wrong track. Cause I think to your point, people buy stuff for the ROI. And then I think like the feel good part is usually secondary for most people. Right. So like they don't buy a Tesla because it like helps the earth. They buy it because maybe you save money on gas, or maybe it looks cool, or, something like that. But then it happens to also be better for the environment. And I think there's a lot of stuff like that where, you want to figure out what drives your customers, and then that's what you want to, like, that's where you want to differentiate, and that's where you want to hammer home on your marketing materials, your website, like your sales pitches. Because again, like if Tesla just like, I think if all of their commercials were like, hey, this is the greenest car, and then like you can help the environment, like I think they would just sell way less than if they're just like, hey, this car is really freaking stylish and like it goes really fast and you're going to save a lot of money, and it's like, whatever, like the dashboard's like way better than, your like old car. So like I think those practical things matter a lot more than the kind of like maybe like the emotional motivation some people might have that don't actually translate to like a bottom line.
Yeah, Tesla's a great example of that. Well, so we talked about this a little bit before we jumped on, but talk to me about senior go-to-market hires, or even maybe the sort of mid-career junior ones that you were talking about. From the technical founder standpoint, like how do you know if you hired the right person? When do you know if you hired the right person?
Yeah, it's a tough question. I would say like the best practices I've seen here, one, try to calibrate a little bit, and this is where investors can help, but also your peers. So if you're hiring your first head of sales, head of customer success, head of anything where you haven't done that thing before, or like don't have a lot of experience with it, ask people that and respect, like who's the best customer success person, and then talk to 2 or 3 of those and try to understand like what do they do day to day, what makes them special, like why do they think they're better than other people in their profession. And then maybe that gives you a little bit of a sense of like, okay, here's what like the top 5% or 1% looks like. And then when you're interviewing, you can get a sense of, hey, does this person seem like they're on par with those people? Are they a little worse? Are they a lot worse? So I think that calibration step is important. I think the other thing that can help here is either investors or advisors, if they have experience in these areas, they can help you interview a little bit. Not for every hire, right? But if you have like a couple of key hires and, like let's say you're hiring a VP of sales and 1 or 2 of your investors have sales experience, ask them to interview the person and give their opinion, right? Because I think
do people do that a lot? Like, do you see founders make that ask a lot, or do you think they could make it more often?
I think it's both. I think some founders ask, a lot of them don't, but should. I think it depends, right? And that, like, so I've spent 10 years as an engineer, so like the role I'm most frequently asked to interview is a VP of engineering. If somebody asked me to interview a VP of sales, like I could, right? But to be honest, like I don't have a strong barometer of what great looks like. So it's more like I'll look at the output of different companies, go-to-market teams, and I could say, hey, this one feels like it's executing way better. This one feels like it's behind. But I spend so much less time with like a VP, like VPs of sales, that I don't think I'd be a great person to interview them necessarily. But like maybe one of my teammates that does have a lot of sales experience, like would be a great person for that. And if you're a founder that works with them, you should totally ask. You don't have to do what the investor says, right? It's, unless the investor is like, this is the worst candidate I've ever talked to, and you hire them, and maybe that strains the investor relationship. Like, it's just a data point, right? So like, I don't think it hurts to have more data points on an important hire. So if, the investor is like, oh, I think this person's an A+ or a B, you can still decide to either not hire the A+ or hire the B if you get more data points, right? Because you could be like, hey, you thought they were a B. I talked to 4 other people thought they were an A+, so we just hired them. But like, I think having that data point, having that additional perspective from somebody with experience in the area, I think that's really valuable.
Yeah, that reminds me of a couple of, when you get obsessed with the person that's an A+, and then you end up probably overpaying or, overcommitting to that particular hire because one investor said, oh, this guy's great. And then you don't realize like there are other people out there. If that one doesn't want to leave Google or what have you, you don't have to give them a big chunk of your company just because one investor said he was great.
Yep.
Well, this is what I was just asking was, I think, which fits this is, what do you wish founders would ask you for that they implicitly don't now?
I would just say, like, I wish they asked about more things. And I think investor emails are probably the place where I see this the most, because a lot of companies send like a monthly or quarterly or something like that investor update. And a lot of them will have like, here's what happened, here's like some of the good stuff, here's maybe some challenges we're facing, and they have an ask section. And there's a ton of companies where the ask section is just the exact same thing, like month after month. Right? Like, oh, we're looking for good engineers. And it's like, okay, well, the first time you add that, that's great. Like if somebody has somebody good in mind, like before that person to you, maybe like, 6 months later, if you ask again, there's like some new person they met. If you're just asking for that month over month, like after a month or two, I'm like, okay, well, I ran out of candidates. Like I sent you the 6 engineers I know they're looking, and you keep asking for the same thing, and I can't help any more with it meaningfully. But like if you ask me about, hey, I have a website, we just redid the marketing copy. Like, what do you think from like, a layperson's perspective? Or like this thing is happening. Like if you have experience with it, like want your advice. So I think like founders should just ask for more stuff, right? Because if you have 5 asks in every email and maybe the 5 change email to email, you kind of get a lot of different help. If it's like the same ask and it's the same every time, like, at some point, like you tap out pretty quickly.
Or you just tune it out. Yeah. I mean, it's the other one that I've seen a lot is we need more customer introductions. And it's like, who doesn't? But I think your investors probably tried the first time, and they're not going to start sending like email campaigns to their friends.
Yeah. And I think on that note, actually, it's I think it's one of those things that doesn't scale well, right? It's almost like having a lot of pilots that are not converting.
Right.
It's like a different flavor, which is you can get your first 20 customer intros from VCs or investors or angels, or maybe it's your first 50 or your first 100. It's not going to be the first 10,000. So like at some point, once you have enough to understand, like, here's our customer profile, here's what they need, here's like what resonates with them, I think you can keep going to investors as like a nice to have for like maybe there's a few more intros, but you need to figure out like, well, how do I get to like the next scalable thing, which is, I start getting leads where it's like hundreds of leads or thousands and not ones and tens.
Well, I assume if you go after your Series B and your main lead source is your board, right, it probably starts to look not good.
Yeah. I think there's probably very, very few industries where you could make a case for that. Like maybe if you sell like, $10 million warehouse systems and your Series B investor can use you for, like that's pretty valuable. But there's so few instances like that. Like for the most part, you need to scale beyond investors, after your first few or maybe a few dozen customers.
Awesome. Well, this has been great. I had a couple questions to wrap up. First, of course, is there anything else that we didn't talk about that you wanted to mention or talk about from a go-to-market and investing standpoint?
I think maybe the last thing I'd add, kind of going back on what I said about investor intros, I do think at pre-seed and seed, there's a lot of value to like picking an investor syndicate carefully. And that, like you're going to raise the round you raise and you'll have the money you have, but you'll have different people around the table. And what I've seen is, I think like a lot of thoughtful founders will try to, kind of arrange a syndicate to help them in different ways. And then people that, like are more in a rush, sometimes they'll just like pick the same kind of investor over and over. Right. So it's like, oh, I got like 6 high signal seed funds into my round, so it'll help me with the Series A. But it's like, well, you could have had 1 or 2 high signal funds and then allocated the rest like to people that can help you with customer connections, or they can help you with like engineering challenges, or, hiring a VP of sales or whatever it is. So I do think that's one area that, is good on the go-to-market side, but also in general is, think about your investor syndicate, right? Because maybe it is people that can help you with go-to-market in some way, or maybe they have a Rolodex of customers in a certain area you're interested in, or something like that. So it's a good time to be thoughtful, because you'll have the cash you have, but you can get additional help for it.
I have to ask, even though we're wrapping up, but where do strategic investors fit into that at the early stages? Because they come in with a lot of promises of distribution or credibility or what have you. But do you have experiences, good or bad, there?
I'd say I've had both. I think one is it depends on the stage. I usually see it more at Series A or B than seed or pre-seed, especially pre-seed. And then I think some of it depends on industry dynamics, right? So like if you're in some industry where, let's say like AWS is like a key infrastructure provider, and you're like AWS's preferred partner for some kind of infrastructure, Like, I think that gives you a lot of legitimacy. I think there's other industries where like corporate investments actually hurt, right? So like, let's say you sell to the airline industry and like Delta invests in you. Well, now maybe a lot of the other airlines are like, wait a second, like you're funded by your main competitor, like maybe we should work with you, right? So I think there's trade-offs. I think sometimes it gives you legitimacy, sometimes it hurts. Sometimes it's like a good way to, kind of fast track a contract with the company. Sometimes they're just investing for financial reasons, or they want to like block your M&A transaction and try to acquire you in the future. So, I think it really depends acquired or corporate to corporate.
Yeah, I've seen that last one a lot, and nobody says, oh yeah, we just want an option and we want to like kneecap you if you want to sell to our competitors when they're trying to get you to take their investment. But like they might be thinking it, and founders I think they're optimistic people, and they're like, oh, but they're so nice. And never mind that they kneecapped like 3 startups in the last 4 years, like people kind of want the best or want to see the best.
I feel like it's like with any VC, you want to do your reference checks, but I think a good proxy is like how much money are they putting in relative to their balance sheet, right? So if it's like Microsoft putting in $100K, like it's an option check, right? Because they could lose $100K and they wouldn't even notice. If it's a company worth like 200 million putting in $3 million into your round, like that's actually that's kind of significant, right? So.
Yeah, no, that's a great point. And it's more probably existential for that company than it would be for Microsoft. Yeah. If anything at this point is existential for Microsoft. Well, so something I'm asking everybody, what are 3 practices you wish every founder would do? It doesn't have to be go-to-market specific, just in general.
I think we've kind of touched on a few of them. So I would say like, 1, I think being deliberate is important. A lot of times people kind of pick the thing they're familiar with or the thing that, some competitor did. And maybe that's the best thing for your company, but maybe there's a better path. So I think kind of like being deliberate about the path you pick and maybe experimenting if you're not sure, I think is important. Like I said, I think asking investors for more things, it's like they're already in your cap table. Like, why don't you get more value out of them?
Right. You already paid.
And then, maybe I'll reinforce, like, I think having a better investor syndicate or like, again, maybe this is being deliberate, but about the investors you pick, I think that's another good one, right? It's like, don't get 6 of the same investor, get 6 different ones that can help you in 6 different ways.
Right. That's really helpful. That's really helpful. Last question is the best advice you ever got. You don't have to have taken it. I can go first while you think. So during Perfect Price, right around when we talked to you, this other investor who I won't name because it's the internet, it was me and my co-founder who was a PhD in machine learning. And he was like, you guys really need to hire a product leader or like somebody to do product. And we didn't like him. We just didn't like him. So we were like, screw you. We don't need a product guy. We got this. And that was definitely the thing that we failed at. And if we had hired a product person when he told us to, we probably would have been much more successful. But I just didn't want to hear it. So I'm curious if you have any advice that you might have taken. You don't have to be like me and not have taken it.
Yeah. There's a couple that like I think of. One is one I try to take, but I'm not always good at remembering it. Is there's this David Foster Wallace quote, which is something like, you'll care less about what people think about you when you realize how little they think about you, or something to that regard.
Right, that's a good quote.
And it's sort of like depressing at first. You're like, oh, nobody cares about what I'm doing, but then it's kind of liberating because it's somewhere like, oh, nobody cares about what I'm doing, and like I can F this up, and it'll like sting, and maybe for a month or 2, people would be like, oh, like Leo's not competent, or whatever. But like in 2 years, like nobody remembers and nobody cares because they're all worried about their own things. So I think it's a little bit liberating to like take big swings and go for long shots and try experiments, because not all of them will work, but even if they don't, it's not a big deal. And like, unless you're like committing fraud or something, it's not going to really bite you for the most part.
Right.
But the upside is really big. So that's one that like I try to follow it, but I often forget because in the moment it's hard to remember that sometimes. The other one that I like that I do try to always stick to is I think I heard somebody say once where it's like, you never regret being too nice. And I've seen a lot of people in this industry, especially on the VC side, sometimes on the founder side, where like you treat people like you're kind of an asshole, or like maybe you're nice to the people above you and like not that nice to the people that are under you. And I think all of that stuff is like it comes back to bite you eventually. And I think also just like being nice is like such a better way to live life. And so that's something I've really tried to follow.
That's a great note to end on. I really like that advice. I hadn't heard that before, but I think I'll start doing it. Well, where can people find you if they want to reach out to you or SUSA or your new fund?
So on the email side, they'll go to the same place, but it's leo@susaventures.com, SUSA, or leo@humbaventures.com, HUMBA. So I can look at companies that are both on the traditional side or the deep tech side. And then I have a blog it's codingvc.com. It's a little stale, but I keep meaning to write some.
Yeah, but there's some really evergreen stuff on that blog. So highly recommend.
That was my goal, where I was trying to write stuff that was like more timely than like, here's the cool like 3D printing company of 2015, and then after like
it's still a lot of the stuff on that blog on your blog is still super relevant. It's super relevant because it's this kind of stuff, but more aimed at technical people.
Well, thank you. I appreciate that. And then the last place is Twitter, which I've been a little less active on recently, but I'm Polovets at Twitter. So it's LPOLOVETS.
Awesome. Well, thanks again, Leo, for joining us. This has been great. It's always great to catch up, and I really appreciate your perspective, and I hope it's useful to everybody who's listening. Thanks.
Thanks, Alex. It was a lot of fun.